In this video, I'm going to share with you my very own market structure strategy. This strategy is the entire reason that I am profitable. And it's also the exact system that all of my inner circle students use to get results like these. This is going to be a full step-by-step course with 8 key lessons. I'm going to start simple, so it doesn't matter if you're a complete beginner or you're advanced, because it will get more and more advanced as we go, and I can guarantee you will walk away from this video with a bunch of value. Stick around to the end because I'm going to be revealing my step-by-step trading plan along with a step-by-step breakdown of a trade following that trading plan, so you know exactly how to do it. Just before we get into lesson number 1, if you're new here, subscribe to the channel for no BS trading knowledge that will actually make you profitable. And if you're already a member of the family, then like the video and comment down below the biggest takeaway that you take from this video. Let's dive in. So here we go with lesson number 1, which is again very simple, something you've all seen before, but it's really important that we set the foundations. So lesson 1, basic identification of smart money. In other words, understanding the actual intended direction of price, right? Very simple concept. So essentially at all points in time, price is ranging from making higher highs and higher lows or lower lows and lower highs. It's either bullish or bearish. If price is bullish, we're looking only for buys. If price is bearish, we're looking only for sells. It's really that simple. How do we identify whether price is bullish or bearish? Well, we use these external swing points, right? So if you look at any price like this, you will see that price has these swings on it. And essentially, you just want to map out all of these swing points and you'll notice whether or not they're trending upwards or downwards. It's very simple. So we start off with a low. Then we have a high, then we have a higher low. This low is higher than the previous low. Therefore, it is a higher low. That already in of itself is indicative of higher prices, right? So we have low, we have a high, we have a higher low, and then a higher high. This is a break of structure. If you're getting a break of structure, a bullish break of structure, that is bullish. You are expecting to buy. You're anticipating price to trade higher. Then you have another higher high, and then you have a pullback. Then you have a higher low. Then you're again expecting higher prices at this point. So another break of structure gives you another higher high. And now at some point, like in every market, the trend will shift. At some point you will be trading bullish like this. And then eventually you'll have what we call a change of character. The change of character is essentially the shift from bullish to bearish, or it could also be bearish to bullish. Essentially change of character. If you think about the market as 2 characters, a bull and a bear, we shift from bullish to bearish or bearish to bullish. That is a change of character. It's very simple. The change of character is the first phase of a market reversal. So when you get a change of character like this, then essentially you can see that we've now gone from, we had a higher high and now we have a lower low. So from there, it's likely that we might get a pullback and then get a lower high, meaning that this high right here is lower than the previous high, right? Indicative of lower prices. Then you get a lower low. So then you have a break of structure. Once you have a change of character followed by a break of structure, that is absolute confirmation that the trend has shifted and it is now bearish. In a bearish market, it's very simple. What we wait to do is we wait for price to come back up into these levels, and then we expect price to trade lower again. And our job is to identify how we get involved in these levels. And that's what I'm going to share with you in the next few lessons. Okay, moving into lesson number 2, which is a little bit more advanced, but is actually really simple. It's the reality of smart money price delivery. You see, what we just previously covered in the first lesson was something that is extremely basic. And the reality is that's not how price delivers itself. If it was that easy, everybody would always be on the right side of the market. So let me share something with you. This right here is how price most likely looks in reality. But really, you can just apply the same principle. Let's take a little look at this, right? So we just want to identify the external swing points. So we go external swing point 1 in here, external swing point 2 in here. Price pulls back, external swing point 3, external swing point 4. Okay, great. We are bullish. We've had a break of structure up. We are bullish. That is confirmed, right? So now what? Well, what you can do is essentially you can draw a box from the low up until the structural high, and you can just drag this box across like this, and essentially you can wait for a break out of this box, right? The box method. You can wait for price to break out of this box. Now, the reality is the highest probability is that the price will break the high, right? That is what you're expecting. So when price does, you can see price breaks out of the box. There is obviously your break of structure, right? Break of structure here. So we're still continuing bullish, but now you have all of this price action inside of here. This is where most traders go wrong. In fact, I would argue that 95% of traders lose money because they always get caught on the wrong side of the market. Here's an example of that. What a lot of you guys will do, or traders in general, is when we see that we are bullish externally, so our swing structure is bullish, but then we start getting this order flow, which is what we call it. It's internal structure. When we get this, price pushes in lower like this. When we get something like this, right, you guys are so quick to jump on the bandwagon and expect that now price is bearish, right? For some reason, you think that price is bearish because it's putting in these lower lows, when actually this is just a pullback, which happens after every break of structure. But the problem is most people think that the pullback is actual structure, and they get confused. And so what happens is they see this type of break in here, and they're like, okay, I think we're bearish. And then they see another break, and now they want to try to short. And so what do they try to do? They try to short in these levels in here. And then what happens? They just get stopped out most of the time because they're on the wrong side of the market. We was always expecting price to trade higher. We was just waiting for the confirmation. We were just waiting for the pullback to be complete. And in later lessons, I'm going to show you how we will understand this pullback. But it's also very simple. You can see that price is bearish on the way down. Great. And then when it realigns like this, now what you've had is an internal realignment with the external. That is your gold, right? You've had a little internal break of structure, a little internal change of character. Now you have confirmed that you are ready to go and target what? The old high. And so then you want to be getting in areas like this, in here, stop loss below here, and taking your profits up in here. Now I'll explain obviously as we go on in more detail how we're going to be executing that. But that's the premise. It's really simple. And so what happens? Well, we break out and we put in a higher high. Now we need to identify the swing low, right? Because in every scenario, we always have a low and a high. Now we've got our high. We know this is our new high. Where's our low? Again, a lot of people will make the mistake in thinking that this is the low in here, right? This is the low, when actually it's not. And how we identify that is you look inside the previous price range, which is this low to this high, or you can use the box method, which is the same thing. It's essentially encapsulating the previous price's range inside of an area so that you can just see it for what it is. And so what then you want to do is you want to identify the lowest point in price that we pulled back before we broke. So we break here. Where's the lowest point inside of this box? It's right here. Right? So that becomes our new low. So we have low down here and we have high here, right? That becomes your structural range. A lot of people make the mistake of using this low in here, right? And then what happens, genuinely what happens a lot of the time is the reality is this down here is our low. And then what happens? Price puts in a high, and then you get price that comes like this, and it breaks this internal low, not the external swing point, the internal low. And then what do people try to do? People then try to short the market, not realizing that it's fine that price has manipulated this low. The real structural strong low is in here. As long as this stays respected, we're still bullish, still expecting higher prices. That's again something that we're going to dive deeper into a later episode. So don't worry if you don't understand it right now. You will. It will make sense. So we have our swing low, our swing high. Great. We are bullish, obviously. We have a pullback, and then we have a new higher high. So again, bullish, break of structure. And then as always, at some point in time, the trend will fail and we will shift from being bullish to being bearish, right? That is what we call our change of character. We get our change of character. Now what are we anticipating? Now we're likely anticipating lower prices. So again, in this scenario, you can see that we have higher high, lower low. What we would want to be waiting for is for price to reach back up into an area of interest, which is something I'll explain later, inside of this bearish price leg in the premium area, which I'll explain. And then we want to be looking at shorting from this level and targeting the weak low. Simple, like this. And then what happens? We have a break of structure and now we're bearish. So you tell me, what do you think is going to happen next? We are going to have some kind of pullback like this one, and then a shift. And then guess what? We want to be shorting in these moves, right? We're just trading the order flow. It's just the trend, but we are actually trading it accurately and not trading it like a lot of other people look at it and they get caught inside of the price ranges. And that's why they go from thinking, okay, price is bullish, I'm going to buy. Oh no, stopped out. Okay, I'm going to sell. Oh wait, stopped out again. Now I'm going to buy. And over and over and over again, you find yourself putting on trades and your stop loss just gets hit. And then you think, okay, now I'll put another trade on, and then your stop loss gets hit again because you're trading internal structure inside of price ranges that you're not supposed to be trading inside of. You need to wait for the right moments. Market structure is incredible, but it has to be paired with timing. You have to understand when is the right time to act. When are we in the important areas? Which gets me on to lesson number 3. Lesson number 3 is all about increasing the odds with the concept of premium and discount. Again, it's a very, very simple lesson, so stick with me. It shouldn't be difficult. So what we can see right here is we have bullish price action, right? We have a low, we have a high, we have a higher low, and then we have a higher high. So we've had a break of structure like this right here, break of structure. Great. A lot of traders make the mistake of trying to buy the breakout or something like that, right? When price breaks structure, they're trying to buy, or they're trying to buy up in here as price breaks out, not realizing that after every break of structure, at some point in time, there's going to be a pullback. And the best traders, you want to hit high risk to reward trades, you want to be consistently profitable, then you need patience. And you need patience to wait for price to have its pullback. Once it's completed its pullback, then you can initiate. The problem is everybody wants to jump in the market too quickly, and they try to get involved when price is already in the premium. So what you can do is you can take the low like this and the high like this, and just like I have, you can take the Fibonacci tool, which is your little tool that's literally right here, fib retracement. Look, and you can pull it out. Yours, if you haven't used the fib before, yours will look a right mess. So if you just go into your settings really quickly, you just want to make sure that you have 1, 0.786, 0.5, 0.618. You can change the colors to make them more attractive. You can edit, I don't like to have all the prices on there and all of that sort of stuff. I like to keep mine really clean because I think that having a clean chart is very important for your psychology and for just a bunch of other things. But what you want to do is you want to take your fib once it's set up, take it from the high down to the low. In this case, I need to reverse it. And then what you will see is you'll have 50%, which literally resembles 50% of the price leg. It is right in the middle between the high and the low, right? We know that with a statistical probability, more times than not, when price breaks structure, it will pull back into at least the 50% and then trade higher again. We know that with statistical probability. The data is there. Go and test it for yourself if you want to. But price after a break of structure will pull back at least into the 0.5. And a lot of the times we got this golden region right here, right? Which is called the 618 and 786. A lot of times, if you want to add more confluence, when price gets into this level right here, this is also a very optimal area to look at entering into the market. You are essentially at 618, 786% retracement. You are primed to go higher. So what we have then is in a bullish scenario, you just split the price leg in half. On the top half, you have premium. On the bottom half, you have discount, right? It's actually a very simple concept. If you think about it, this market is just people buying and selling. So let's ask the question. If you were to buy, would you want to buy if you were smart money, right? The ones who really move the market. Not the ones who lose the money, the ones who make the money, the ones who move the markets, the ones who have the power. If you wanted to buy, would you want to buy at a premium or would you want to buy at a discount? Very simple, right? You would want to buy at a discount. So you would wait for price to trade from this level into a more reasonable level to then go higher. That is essentially how you're going to make your money. Now, here's another thing. If price is here right now, price is in the premium. We've already just broken an old high. So we are in the premium. So think about it. Do you think that smart money or any market participant wants to buy the premium? No, it's all the dumb money that are buying premium. What do you think smart money and other members of the market are doing? The ones who are profitable, the ones who move the market, they are selling premium. If you want to sell something, you have whatever it is in your house, think of an object. If you wanted to sell that object, would you want to sell it at a discount or would you want to sell it at a premium if you had a choice? Obviously, you want to sell it at a premium. You want to get as much for what you have that you can. And when you want to buy something, you want to buy it for as little as you possibly can. So when price is in premium, there are more sellers, obviously, because sellers like to sell at premium. And when price comes into discount, there are more buyers, because buyers like to buy at discounts. That is why price a lot of the time comes into this 50%, into this discounted area of the price leg. Buyers come into the market along with us, and we buy in with everybody else who's moving the market, who is buying in at a discount. And we let everybody else who's trying to buy the breakouts, the price too high up in the price leg, we let them guys buy in the premium because they are liquidity for the sellers. So very, very simple concept. Now, a bonus point for this one is 3.1, which is a bonus confluence, which is an inducement, right? If we look again at the reality of market structure, like we did recently, you will see that the actual pricing will look like this, right? You'll have a low, a high, a lower low, a higher high, a lower low, a higher high. Very clearly bullish. Break of structure, break of structure. This is the low that's in control. When that low gets broken, it has shifted from being bullish to bearish. Now we have change of character. So now we're bearish, right? Again, very, very simple concept. We're bearish. Price does what? Price pulls back into the premium, and then it sells off, gives a break of structure. So we had lower low, and then we break structure again. The highest point that price pulled back before breaking it was this right here. So we have our swing high here, and our swing low is down here. Well, again, same thing. What you can do is you can take your fib, and you can go from, you know, your swing low up to your swing high like this, and that's going to give you all of your fib settings, right? So we have 0. Here we have the 50%. So that's what separates premium and discount. So up here is a premium, down here is a discount, right? Price is lower, it's discounted. Price up here would be premium. So we've broken structure, so we're bearish. We want to sell. We never want to buy in a downtrend because we don't know when price is going to reverse. We want to wait patiently for price to come into our levels, and then we want to sell. That's how we win the game of trading, with higher probabilities, higher risk to reward, and more consistency. So we have it separated. Discount down here, premium up here. Buyers are likely going to step into the market at some point. They do step into the market, right? And what we see is you see these little internal highs like this. And anytime that you get, you know, a high like this, or maybe sometimes you get equal highs or ranges or support, resistance, you know, all of these kind of traditional retail type of strategies. Anytime that you have those inside below the premium, it's a bonus. It increases your confluences. It increases the conviction of the trade, because now there is liquidity to take before price runs into a point of interest. So what we do is we want to position ourselves, and we want to identify areas of interest that are inside of the premium, and ideally bonus points if you have liquidity to take on the way up. An old high, some equal highs, anything like that, that is sitting inside of the discount. Why? Because again, unfortunately, what happens is a lot of traders don't use the structure that we're showing you right here. They often look at these little internal spikes like this, and they think that, okay, price is bearish right now, and great, it is, but they're going to try and sell from these levels. They're going to see equal highs or resistance in these levels, or whatever it is, or breakouts or breaks and retests, you know, all of these different ideologies of how the market works, which is going to do what? That is going to leave a lot of stop losses up in this level. So that's a good thing, because we need that liquidity so that smart money can get better averages in prices, right? When the liquidity is present, it is not accidental. So when price comes into these levels, you know, gives you, even sometimes will give you some reaction, we've created liquidity, right? Sellers are trying to get into the market. When you manipulate that, now what happens? Not only have you just taken out all of this liquidity in here, you have also now, in the eyes of many, broken out, right? So now you're bullish. So what are people trying to do? People are now trying to buy, right? People are now trying to buy, which is perfect, because now we have the opposite side of the market. So we are looking at price then coming into these areas, and then essentially get the shift down here, because what that creates is when everybody's trying to buy, it creates the liquidity to target in here, the liquidity to target in old lows. Again, something I'll dive a little bit more into detail on when we get into the actual trade breakdown. I don't want to kind of confuse a lot of you guys, but a lot of you guys who are already, you know, familiar with the channel already know that I go deep into liquidity concepts, so no problem. Let's go into lesson number 4. Okay, lesson number 4, something that many of you guys probably haven't heard me speak about before. I don't think I've really spoken about weak and strong structure on the channel that much because it's a very, very important concept. So let me kind of share it with you. So again, as always, we need to obviously identify our structure, right? Are we bullish? Are we bearish? Okay, great. We are bullish, right? So by definition, the job of a high is to take out a low. The job of a low is to take out the high. That's it. If a low succeeds in taking a high, that low becomes strong. For example, if we see that this low here has managed to break this high here, this is strong. It becomes protected. Why? Well, let's think about it logically for a second. Let's say, there are sellers in here and buyers in here. Very obvious. There's a buy side intention and sell side intention. Well, let's say you have, one person called Jack who is the seller here. And then you have Jill, who is the buyer. Well, if Jack started selling here and Jill started buying here, if price breaks the high of where Jack was selling from, who do you think is the stronger participant in the market? It's obviously Jill, because Jill has more money that can move past Jack's pain price, right? Pain price being the point where if it takes this high, he is now running in a loss. Very simply put, he is weaker because he has less deployable capital. Very, very simple. Why is that important? It's important because if you know that buyers have control of the market, well, guess what? They too need to protect this low. It's very simple. They need to protect it because at any point in time, if price was to go past this low, well, guess what? They lost money or they're in drawdown because this low is the final point, the lowest possible point they could have got their positions in. So the moment price runs that low, they're going to be running at losses. So what happens a lot of the time is these lows are protected so that when price comes into these lows, guess what? If they still agree with their initiative, they will use more buying power to continue making price higher. This becomes a strong low. It's strong because it's protected. Same thing again. If you're bullish, the role of this low, this high right here now, is the role of sellers is to break past this low. The role of this high is to break past this low. That's its job. So the moment that you see price come down and then begin to start reversing like this, it's already been confirmed that this is a weak high. Why? Because it wasn't able to take out this low. The moment that it starts reversing, it tells us buyers have stepped back into the market. This is not going to hold. It's targeted, right? That's why structure moves. Low, break of structure, high, shift, weak low. Price starts coming back. Okay, the role of this high is to break this low. That's it. Sellers want to gain control of the market. They have to take out the buyers. The buyers are positioned all the way in this price leg, and it's confirmed that the buyers have taken out once this low is taken. And guess what happens? Price comes down, can't get past even this part of the price leg, and then begins to reverse. When price begins to reverse, it's confirmed. This is weak. It gets taken out. And then what happens? Price shifts up, and then we get a change of character, which again, at some point in time, trends become exhausted. Because think about it. If the entities were buying back here, right, and they were the ones that are pushing price, well, at some point in time, their initiative gets complete. They get out of the market, or they no longer want to deploy capital at those same prices. If they have average buy orders in here, they don't want to keep buying price up in here. So trends become exhausted. The higher a trend goes, the more that probability increases on every new swing point that we could get a reversal. Why? Because the buyers have already initiated their positions. Obviously, there are exceptions, but typically speaking, the higher that price goes, the increased probability of a reversal. So let's say, for example, you have market structure. Every time we put in new highs, the probability begins increasing that the next time that price goes to try to put in a high, it will fail. That is the probability. Again, go and test it for yourself. It's just the data. Low, higher high, higher low, higher high, lower low. Change of character. So now we've shifted, right? So now this is the strong high because sellers have overwhelmed buyers, right? Very simple. So now if they want to stay in control of the market, they will protect this high. Buyers come in. The job of this low right here is to do what? Is to take out this high. So when it comes up and then starts reversing, well, it's failed to do its job, so it's weak. But then there are going to be times where price may get back into this level and buyers, in this scenario, they try again. And so then what you will then see is if you get a scenario where this low fails to take out this high, and then it comes back, but then this high fails to take out this low, well, now this high is weak. And so now this high can be targeted as liquidity. And there you go again. Then it takes it. Okay, now tell me what? The responsibility of this high when it starts coming back down is to do what? Is to take out this low, right? It's still this low. And so great, when price begins pushing down like this, it looks like it's going to. But the moment that it shifts like this, the moment you get this is confirmation that this is targeted, right? It's not going to happen. This high is now going to be taken. It becomes weak structure. Again, price takes the high, begins to reverse. The role of this high is still to take out this low. And so it goes to. The moment that it starts reversing and you get an internal shift in here, this becomes weak, right? And then eventually, most times, especially if you are already pro-trend, we're already bearish. So this is most likely strong. This is most likely weak. When it gets run, becomes a different matter. And eventually, at some point in time, it will most likely be run, right? Based off of probabilities, there's a higher chance that this change of character results in a continual break of structure afterwards. So that is kind of understanding strong and weak structure. Strong structure, break structure. If a structure point breaks something important, if a low breaks a high, it's strong. If a high fails to break a low and then we start reversing, it's weak. It becomes targeted. If we are pro trend, right? So we have higher high, lower low. Immediately, this is strong. There can't be two strongs. So this is already considered weak. It's like that saying, you know, innocent until proven guilty. Well, this is weak until proven strong, right? This low right here would have to break this high to regain its status of being strong. So whilst it's weak, by definition, it becomes our target. That is why we trade premium areas of structure. If we look, this is around about 50%. It's bearish. What would we be trying to do? We would be trying to identify an area of interest in here, and we would try to sell from this area, and we would try to target this low down here because this is strong. So we want to be selling with the strong structure, and this is weak. We want to be targeting the weak structure. It's actually very, very simple. And you will see, if you look closely at this piece of price action, this is the exact delivery of price that we got on the Euro USD shorts that we'll walk through step by step at the end on the actual charts. Okay, let's dive into lesson 5. Lesson number 5, my favorite concept. It's an advanced concept and arguably the most important of everything. But you can't have this without the others. That's why we had to build off of each other. So lesson 5 is advanced. It's fractal market structure, and it's the key to high risk to reward trades. Let me break down what I mean by that. So let's kind of pull this image apart just for a second. Let's move you down here. Let's move you down here. Let's strip it back to the basics. So just for definition, you can see that, you know, the bold black arrows are the 15-minute time frame. That's what that represents, the 15-minute time frame. These in here, right, as you can see, these kind of little candlesticks represent the 1-minute time frame, right? What you have to understand is that every time you have a move like this on one time frame, a very clean run like this on a lower time frame, that will be, you know, let's say on the 15-minute, that's 5 candles, right? Well, on the 1-minute time frame, it's going to be a lot more candles, and they're going to be a lot more erratic. They're going to be up, down, up, down, up, down, up, down, up, down, right? It's going to be very much like this, which we'll get into in just a moment. So step number 1, identify, you know, where are we structurally? Okay, low, high, higher low, higher high, break of structure, bullish at that point in time. Lower low, change of character. So we're bearish. Okay, awesome. Now, that is the 15-minute swing points. So don't forget that as of right now, the 15-minute is bearish, and those are our swing points. This is possible to be our swing point. Okay, so now let's kind of bring in the 1 minute, and you can already probably see where I'm going with this. Let's apply this on here. Now, we know where the M15 swings are, right? So let's just make them clear. There's the swing, there's the swing, there's the swing, there's the swing, higher high, we were bullish. Then we get a new swing that's lower than the previous swing, which is lower low, and then potentially this swing. So in red right there, you can see that that is our M15 structure. Well, now if we change to blue, what we want to do is we want to look at the 1 minute structure, because what happens is as the 15 minute is building itself, guess what? The 1 minute time frame is printing the price action for the 15 minute candle. So the 15 minute trend is first delivered on the 1 minute time frame, right? You get to see the delivery of the trend. You get to see the buildup of the trend. And what happens is it will give you fractal signs. For example, if we look at the market structure of the 1 minute time frame, we will see that we have a low, a high, a higher low, and a higher high. So the 1 minute is bullish, right? Cool. That is the kind of, extension phase of the 15 minute. That is when the 15 minute, you're watching the 15 minute, go and put in bullish price action, right? And then we get a lower low and a higher high. Again, this 1 minute bullish structure that you see is the 15 minute. On the 15 minute, you just see this. Now, what happens is at some point in time, the 15 minute gets ready for a pullback, right? It's pullback period. And that becomes evident in the 1 minute first, before you even see it on the 15 minute, because you get this little shift in here, right? If we look objectively, we had a 1 minute break of structure like this, a 1 minute break of structure, and now we've had a 1 minute change of character. Well, this change of character and break of structure model in here, this reversal, we see it on the 1 minute, and that tells us that the 15 minute is now pulling back. So we get lower low, lower high, lower low, right? And when the 1 minute is bearish, what's the 15 minute doing? It's pulling back, right? This price leg in here. And then at some point in time, you'll get the shift. You'll get the bearish break of structure on the 1 minute time frame, right? Because the 15 minutes pulling back. And then before the swing high is even taken out on the 15 minute, you'll get a 1 minute change of character like this. And this change of character tells you that now the 15 minute is reversing. So the higher high, we know now that the 15 minute is going to put in the swing high. Again, we go higher low, higher high, break of structure on the 1 minute. Change of character on the 1 minute. This change of character tells us what? We've just broken structure on the 15 minute, right? There's our 15 minute break of structure. And we've just had this confirmation. Well, guess what? Now it's time for the pullback of the 15 minute. That's why we get lower low, lower high, lower low, lower high, lower low on the 1 minute. And then we shift, right? We have our change of character on the 15 minute. So we shift bearish on the 15 minute time frame. Change of character. And then guess what happens? Then we shift to bullish on the 1 minute. Why? Because now the 15 minute is pulling back. So the 1 minute goes bullish, we get a break of structure, a change of character, we get low, higher high, higher low, higher high. So the 1 minute is bullish right here, right? But the 15 minute is bearish. So what we do is we wait for the 1 minute to align itself with the 15 minute inside of a key area. So if we strip this apart right now and we look at everything objectively and we start applying everything that we've just learned, you'll see the outlining of exactly what it is that we do for this strategy. So step number 1, 15 minute structure. We're going to mark it in red. We have low, high, higher low, higher high, lower low. Okay, so we're bearish. So we are only expecting price to short, right? We only want to look at shorts. Let's take our fib from the low to the high of price. We have the 50%. Perfect. So price is already inside of the premium. Okay, great. So we want to, our goal is to sell the 15 minute trend in the direction of the trend and above the premium when we're selling. So instead of just using this structure, because what you could do, and by the way, this is a profitable strategy, I've already tested it. If you look at the 15 minute structure and you literally just use the fib and you do the 618 and you have your stop loss at the high and your take profit at the low, that is a profitable strategy, right? It has a fairly high win rate. You could also use the 786 if you want to get a 1 to 3 risk reward. But even this right here, right, 1 to 6 risk reward, even with a 50% win rate, you'll be profitable. And market structure has over a 50% chance of continuing in its trend, right? Given the rules that I apply for market structure. So it's profitable like that. But that's just 1 to 6 risk to reward, right? I'm not waiting and trading for these 1 to 6 risk to rewards. That's why I say that fractals are the key to high risk to rewards. Because what we do is instead of just trying to trade this in here, we go to the lower time frames. We only go to the lower time frames when we get into an area of interest. So once we start approaching these levels in here, and once we have our areas of interest, right? Our areas of supply, our points of interest. Once we get into those levels, what we do is we go and look at the 1 minute time frame. And so what we see is, okay, cool. Price was, the 1 minute time frame was bearish. Okay, awesome, makes sense, because that's when the 15 minute was bearish, and then it shifts bullish, which means it's the pullback. And then when price starts getting into the areas of interest for you, well, you already expect that the 15 minute is going to take out this low, because this is a weak structure. So that's our target. But we want to get in before it gets there, obviously. And we don't want to just take the trade from here because it's not high enough risk to reward. So we use the 1 minute time frame to confirm and get in early. Because when we see that when price pulls back, the 1 minute is bullish. The moment that price shifts from bullish to bearish, like this, on the 1 minute time frame, that is our sign. That's our trigger that this that this low right here has failed to break this high, right? That is the sign of reversal. That's where price starts respecting the high and trading away from it into the direction that we're already expecting price to trade into, right? You get where I'm going here. So that confirms our already firmly established bias. But not only does it confirm it, which increases the probabilities of being correct, it also allows us to enter on the lower time frame. So once you get that 1 minute change of character, you can be on a lower time frame looking for a point of interest, and you can look at executing that. After we get a break, after we get the change of character, you look at getting involved in here, and then you want to be looking at taking out the weak low down here. And the 1 minute time frame, right, is going to continue in its trend. Change of character, pullback, break of structure, pullback, break of structure, pullback, break of structure, as the 15 minute expands into the new low, giving you the already inevitable break of structure for the 15 minute. So very simple. We were 15 minute bearish. The 1 minute was bullish because the 15 minute was in the pullback phase. The 15 minute confirmed that it was reversing when the 1 minute shifted, and we got in on the 1 minute, allowing us what? It allowed us to, number one, confirm our level, which increases the probability of success. Number two, we have reduced the size of the stop loss, right? The stop loss before was from this level, the entry was here, the stop loss was here. Now we have an entry here and a stop loss here, right? So the entry and stop loss is based off the 1 minute time frame, which, you know, usually, as you'll see in the trade, will give you a higher risk to reward. And then we're going to target the 15 minute low because that's where price is going to anyway. And it will always give you a higher risk to reward along with the confirmation. And all you're doing is just trading the 15 minute directional bias. So that's lesson 5. Lesson 6. Lesson 6 is my entry model. We've already just covered it, but I wanted to use this example because it's a lot cleaner and easier to understand. If you were a little bit lost toward the end of lesson 5, this will just make it very simple. Again, in black, that's the 15 minute. In kind of red and green is the 1 minute. So what do we have? We have the low, we have the 15 minute low, 15 minute high, 15 minute pulls back, 15 minute higher high, 15 minute break of structure, 15 minute change of character, lower low. So as of right now, the 15 minute time frame is bearish, right? We've broken structure down here, a change character, sorry. We have our swing high up here, which is strong. Why is it strong? Because it broke this low. So already we expect that this high is going to be respected. We already assume that this, remember, weak until proven strong, this we're already assuming is weak. The probability indicates that this low is likely to be ran. Great. After the change of character, what we want to do is we want to apply our fib at the low to the high, and we want to wait for price to reach into above the 50%. It will always be matched with an area of supply or demand, which is an area of order block. For those of you who aren't aware of that, I will reference you a different video to understand it, or you can just wait until the trade breakdown and you'll see what I mean. For those of you who are familiar with it, then you know exactly what I'm on about, which is most of you guys. If you are at my channel, you will know these concepts. So you will see that the 1 minute time frame is what? Low, high, low, higher high, higher low, higher high. The 1 minute time frame is bullish because the 15 minute time frame is pulling back, obviously. So the confirmation, 1 minute is bullish and then 1 minute turns bearish. What does that do? In that moment, you've just had so much confirmation. You have just confirmed that this is strong. You have just confirmed that this point specifically that you've used is reliable. You've confirmed that this is targeted to go. The probabilities of your trade setup are high. The edge is in your favor. There is the lower low. That's the confirmation. You get in again on an area of interest, which I'll show you. You wait for the natural pullback of the 1 minute time frame, as it does, right? Every time it breaks, it pulls back. That's what structure does. It breaks down, it pulls back, you get tagged in, and then it continues lower into your 15-minute target. The model is literally that simple. We are bearish, 15-minute. We wait for a pullback. 1 minute time frame shift, pullback, continuation. Very, very simple. Now, there is some more important things like context, and that's what we're going to get into in lesson 7 with my trading plan. Okay, lesson 7. The last theoretical lesson before we go and take this into the live charts and show you a real example of this strategy playing out. It is going to be incredible. You're not going to want to miss it. So let's dive into my trading plan. Now, very important, the times of my system, the execution hours, right? So I will always trade this system every single day between the hours of 2 to 5 a.m. EST, which is my London window, and 7 to 10 a.m. EST, which is my New York window. I don't trade before, I don't trade during, I don't trade after. It's that simple. Market. I trade this system on Euro USD and I trade this system on GBP USD. I get so many comments on my YouTube channel. Does this work on gold? Does this work on futures? Does this work on this? Does this work on crypto? Blah, 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 blah. I trade it and I have years of proven profitable data on euro dollar and pound dollar. So trade them. Why do you need to trade gold if I have years and years and years of data on these specific pairs already? I know that this edge works on these systems. If you want to take the edge and go and test it for yourself on different pairs, different assets, fine, be my guest. But my market, and I will always stick to, is euro dollar and pound dollar unless it's one of my other strategies. So to clear that up, that's the times, that's the market, that's simple. Step 1, pro trend. I'm always making sure that I'm trading pro trend, obviously. So if we look at if we identify the trend right now, you will see that we have low, high, higher low, higher high, lower low, change of character. Swing high, strong, swing low, weak. The structure is bearish. So pro trend M15 means I am only looking for short positions on this specific day. That's step number 1. Great. We are looking for shorts. We are bearish. Pro trend done. Identify internal range liquidity. So before my trade has occurred, I like to see it adds an additional layer of confirmation to my trade if I see internal range liquidity. What's that, you may ask? Very simply put, what we just talked about in lesson 3.1, where you get some kind of area of price before your interest area where you have, equal highs or an old high or some sort of liquidity, right? Because what that does, again, is it puts so many stop losses in here. And then when it gets triggered, what happens is those stop losses then become new orders for new people. And then those stop losses go in here. So it just makes sure, and this is how the market operates. This is what's literally what smart money is all about, is that there will be liquidity buy side, liquidity sell side. And the whole idea, and if you've been in trades where you've been manipulated and then price goes into your direction, this is why. What we want to do is we want to wait for everybody else to get manipulated and then get in, because that's when it's safe to get in. So the reason I wait for this internal range liquidity is because there are so many sellers in here, so many buyers in here, and then when price breaks the high, all the sellers get taken out, and then buyers step into the market, and then they step into the market, and then their stop losses are here ready for me to take. So liquidity to take, liquidity to target. I need liquidity to take on the way to my area, and then I need liquidity to target from my area. It's that simple. That is literally it. That is what identifying internal range liquidity is, and you'll find out more about that in my next lesson. Okay, identify a POI to trade from. A point of interest is always some kind of order block. So an order block, in essence, what you can look for is some kind of range before you have a manipulation of one side of the market and then an aggressive move, right? the key emphasis is on where does the momentum come into the market. When you get very aggressive price action, that shows you that a big institution, a big player has stepped into the market, initiated their intention. And what will they do? They will protect their intention by all costs, right? So there's a decent probability that that level will stay intact. So you want to look for some kind of range, a manipulation sometimes it doesn't have to manipulate, but we're looking for a range, and then the main characteristic is aggressive move from that level. And then you can map it out like that, and then that will be your point of interest, and that is your point of interest. So that would be identifying your point of interest. For theoretical standpoint, we're going to say that that's this. We're going to wait for liquidation of key high, low, or a premium or discount point of interest. So what we're going to wait for is we're going to wait for these highs to be taken, right, before we try to initiate any position. We want to make sure that the liquidity is taken out before we try to trade, or you can wait for price to get into a premium or discount point of interest. So if the 50% is here, this is discount, this is premium. Sometimes you won't get this internal range liquidity. Sometimes you will, sometimes you won't. It's higher probability when you do have it, but you can still trade it when you don't. In the case where you don't, you just need to make sure that you are in the area of premium. Absolutely, non-negotiable. So yeah, that is that one. Identify POIs to trade from, wait for liquidation. Once you have got into your premium area or discount area if you're buying, but premium area for us right now, once you get into this one, then you're going to wait for a lower time frame change of character on the 1 minute time frame, which is this, right? We are bullish on the 1 minute time frame, as we've already covered. We are bullish. Low, high, then price begins to range. Cool. Higher high, higher low, higher high. When you get in here, you wait for us to go from higher high to lower low. Okay, lower time frame change of character. That has now happened. Tick. Identify 3 to 5 minute order block, which is what I already just explained. It's kind of that last, buy to sell before the aggression. That is going to be your order block. You're going to identify that area. That is going to be your entry, right? So we're going to assume that the order block is, let's just say, this right here. That's going to be your entry. Okay, there is my entry. All right, let's make this a little bit smaller. There is my entry. Okay, stops above logical high. Well, the logical swing high, based off of all the rules, is this is strong because it broke this low. This is weak until proven strong. So the logical place for my stop loss would be above this high, because your stop loss should always be in a place that invalidates the trade. That's it. Stop loss placement is an area. If price comes to this level, my trade idea is no longer valid. Therefore, I should get out and accept my losses. That is the point of a stop loss. So that's where my stop loss would be. My target, I always partial my profits at 5 risk to reward, right? So 5 RR, I will take off 50% of my profits. That is because it is a mitigation of risk in the event that I am wrong. You can still, believe it or not, you can be wrong that price will continue lower and you can still make money. So you can be wrong and still make money. Yes, you don't have to be right to make money. That is a belief that a lot of traders have to break at some point in time if you really want to become profitable. You don't, being right and making money, they're two completely different things. Sometimes when you are right, you can make money. Sometimes when you are right, you can not make money. Sometimes when you are right, you can lose money, because it's not about being right. It's about where did you get into the market. That's what probably happened to you so many times. You've anticipated lower prices and then you tried to get into the market, you got stopped out, and then price went to where you wanted it to go to. You was right and you lost money. So the reason that I have a partial profit system is because when I gathered all of the years of data to prove my edge, which most people don't do, I realized one thing. I was getting huge risk to reward trades, but my win rate was very low considering what I wanted it to be. Again, a lot of people identify low win rate with bad strategy. At the end of the day, it's a numbers game. What is your percentage return on average each month? That is what indicates profitability. Not how big your risk to reward trades are, not how many trades you win or how many trades you lose, not your win streak, nothing else, period. So the win rate wasn't where I wanted it to be from a comfort perspective. I didn't like to go on losing streaks. So I incorporated and I seen in my data, price reaches this level quite a lot. Let me take off half of my position at that level and then let the rest run. Because if I take off half here and it runs to the full take profit, I will take half here and half here. I'm fine with that. If I put it in here and then it comes into this level and continues higher, I will have still made money and then had my stops at break even, right? So it just really mitigated the risk, and it made a lot more money, right? I was a lot more profitable and made more money on more trading days. It was a win-win. That's what I was trying to do for my system. That is how I did that for my system. That's how the game works. That is my trading plan. And now let's take this plan over to the market and show you a live example of real price action on how this step-by-step system works. Let's go. Okay, so lesson number 8. We're going to be breaking down this trade in the live market, euro dollar, on the day of the execution is the 30th of September. As of recording this, it is the 4th of October. So it was around 4 days ago. As of recording this, I always record actual trades that were part of the plan. You'll see that it's in the exact hours that I've already set in my trading plan. You'll see that everything fits the trading plan. You can take the trading plan, go test it for yourself. Inevitably, you will run into some issues because that's just how it works. You'll probably want some sort of support, all of that good stuff. So before we dive into this, just really quickly, if you've made it this far, you've already shown me that you are obviously a serious trader. You've spent the time on, content that's not Lamborghinis and lifestyle and yachts and buy my course and you can have this lifestyle. No, I want to give real information because I want to actually create profitable traders. So if you've made it this far, you've proven to me that you are serious and you potentially have what it takes. If you want to work close to me, alongside of me, private mentorship, then below this video there's an application. I will be accepting 5 new traders to join my inner circle program. Inside of my inner circle program, we have had traders go from having no idea about the markets to becoming consistently profitable, getting funding, getting payouts, completely changing their life. Everyone. We've done hundreds and hundreds of students have become funded traders, taken payouts, become actually profitable traders. There's more to trading than just the strategy. I can promise you that. But without further ado, if it's interesting to you and you are serious about becoming a consistently profitable trader, then below this video, there is a link that you can apply to work with me directly to get the help that you need to become that profitable trader. Let's get into the actual trade breakdown, what you're really here for. Let's go. Okay, so I'm going to replay it, and I will replay it from Monday morning, London, heading into London Open. This is where I take my live session every single morning, every single Monday morning with my inner circle members and give them my outlook for the week, what exactly it is that I am looking at. We kind of look at the markets, we identify opportunities, all that good stuff. So, I've already documented this before it even happened, but let's go ahead and get into it. What I always do is I actually use this indicator. I'm not a fan of indicators. This indicator literally just shows you time. In the blue box, you will see Asia session. In the green box, London session. In the yellow box, New York session. If you remember my trading plan, you will know that London is 2 a.m. till 5 a.m. We are UTC -4, which is New York. So it's 2 a.m. to 5 a.m. That's my London window. My New York window is 7 till 10 a.m. That's literally all this does. It just shows me the times of the sessions, which is very, very important. Something that I won't go into today, but understanding sessions and timings and liquidity around sessions is so, so important. But let's go ahead and get into this. Now, step number 1, what do we want to be doing? If we get rid of all of this, we want to first and foremost identify our market structure. So if you're looking at this, you need to understand where have we come from, right? So in order to do that, essentially, in a nutshell, what you can do is you can see that this right here is an external high, right? This is an external high. This is an external low. This high gets broken. That is a break of structure. Price comes up like this. Price comes up, higher high, lower low, higher high, break of structure, right? We are bullish, break of structure. And then what happens? We get a change of character. So we go from bullish to bearish, right? Change of character. So at that point in time, we have a swing high up in here, which is a strong high. And we have a low down here, which is weak until proven strong. You notice that there's no pullback inside of here. It's this high to this low. And then all of this is internal price. And if you remember when we were speaking about, weak highs and strong highs, this is kind of how you can understand that as well. Here's our low down here. And this applies for every high, really. Price comes back up. Okay, cool. And then price goes for the low, right? Sellers try to take the low. Price starts reversing. It fails. So this becomes targeted and it runs it. I'm going to change the pen. They try to take it. It starts reversing. This becomes weak. It runs it. It tries again. Sellers come in. They try to take the market. Price starts reversing. That makes this high weak. So it takes the high. Again, in New York session, we try to take the low again. We fail to take the low. Price starts reversing. This becomes weak. We go into the next day. What happens? London session. Once again, tries to take the low. Starts reversing. Fails. Which means what? This high is weak, but also this high is weak, because this is the high that tried to take the low. This high comes down, goes to the low. What happens? Price starts reversing. So guess what? This high has a decent probability of being weak. That's something you can identify already immediately. So when I come into London session, which you can see here in the green box is London session, what I am looking for is I want to sell the market. It's very important for me. If you've been here for a long time, you've watched my videos, you know how important this Asia session is. So I want to see this Asia session get manipulated. Now, there are two different areas here. I had this mapped out. So, you could look at potentially shorting from this level. You could also look at this as potentially liquidity because of the concept I just explained of weak highs and weak lows. The point of interest in question here is this order block. Again, remember when I said you want to look for an aggressive buy before an aggressive sell, right? That buy before the sell is the order block. That's the area of supply. We have mitigated it. We had a reaction. We haven't mitigated the 50% of it. It's a rare occurrence, to be honest, where price mitigates it, comes out, and then goes back to test it again. But in this scenario, we do go to test it again. So London opens, and I'm expecting for sure we're going to get a manipulation of this low, this high, and we can look at shorting from there. Or we can get a manipulation of this high, and we can short from there, right? Again, we are also inside of the premium. If you look at the high, you look at the low, and the 50% is somewhere around here. So anything here is premium, anything here is discount, right? It's quite simple. So we're inside of the premium already. So London opens, that is what we're waiting for. By this point, we've already kind of set the expectations. Price comes into this level, aggressively trades and continues trading. There is no sign of a pullback. So even if you were to go to the 1 minute time frame, you wouldn't have gotten a trade, which is why it's very important to have the 1 minute time frame for the confirmation. So what happens? Well, price eventually breaches on this high. I'll be honest with you, at this point in time, I thought, you know what? Price is probably going to take this high out. And that's why it doesn't matter what we think, only what our edge says. Because sometimes your own thinking can lead you to try to guess. We're not here to guess. I'm here to trade a system that's already proven. So I just need to follow my rules. So in my head, I'm thinking, probably not going to get a trade, probably going to run the highs up in here. Because that's what it looks like it's going to do. That's just speculation, which is what most people do, and that's why they lose money. But we have a plan. So when we get into here and we go to the 1 minute time frame, I'm not really expecting much of it, but as you can very clearly see, we're obviously bullish, which is what you would expect because the 15 minute is trading higher. But what you want to identify is high, low, higher high that meets our pullback criteria. It's at least 3 candles. Right, sometimes you'll see me use 2 candles. That's and sometimes you guys question me for that. There's a reasoning behind that I won't go into too much detail here today, but there is obviously a reason behind it. It's not just changing the rules or something like that. There's a reason. But yeah, to confirm that the 15 minute is going to go lower, you would need to see this break. I'm not trying to short until that happens. We're still inside of our level, right? So as long as we stay inside this box and we break this low, you can short. If not, then nothing, and you won't make money or lose money, no trades. And that's also the good thing about having the confirmation. On this specific day, we get the shift of the lows. So my setup has already occurred in my London window, right? So now I can essentially look at trading that setup. So we can go, what am I looking for? I'm looking for the buy to sell that breaks this level, right? That is essentially it. It also coincides with a different trading strategy that I have as well. But yeah, pretty much that is the model. So there's the confirmation. Break of structure, change of character. I always, like I said, go to the 3 minute or the 5 minute and look for the order block. Here I am on the 3 minute time frame. This is my order block, right? This is where the aggressive momentum comes in, the buy to sell. That is what I'm interested in. That is where I want to set my thingy. Where's the logical high? The swing high. I want to set my stop loss on that high. where do I want to target for this trade? I want to target number 1, 5 risk to reward. As I already told you, that is my partial take profit, right? Partial profit at 1 to 5 risk to reward. And then where's the rest? Just to swing low, right? Structurally, it's expected, probability would indicate that the lows down here are going to be taken. We're just following the edge. So that's what the setup would look like. And again, we'll go into it because you'll see that some things happened and this isn't the actual trade that I ended up making money on. So what you'll notice is I've now been tagged into the trade. The moment that this low gets broken, that is my cue to go to break even. It's also the end of the session, right? It's end of my London window. I'm break even. A lot of times you may see some sort of manipulation between the sessions, so it's something to watch out for. But my session's finished, I'm a break even. Once I get a break of structure like this, right? So I get tagged into my position and then I get a break of structure. That's when I go to break even. So I'm at break even right now. My stop loss is right here. If it gets tagged, I don't lose, I don't win. And then again, if we just play price, because I don't want to spend too much of your time, we play price, and price, everything's going great. New York session opens, everything was going great, and then I get tagged out at break even, right? So there's the break even for the SMC model, but we are back in the same level. And if we go to the 1 minute time frame, guess what? You will notice that if we look at the market structure, right, lower low, lower high, lower low, lower high, lower low, equal highs, I guess, lower low, and then higher high. So now we've had a bullish change of character. So we can look at getting back into the market if we get a shift again. So what do we have? We have lower low, lower high, lower low, higher high, and then you get a change of character. So we have a bullish break of structure, followed by a bearish change of character, right? A bearish change of character inside of here, bearish change of character. We've confirmed again that the 1 minute time frame is now shifting bearish. We're also already where we are on the 15-minute time frame. So you can look at getting back involved again. We go to the 5 minute, we have a look, we look for an order block, we go to the 3 minute, we have a look, we look for an order block. Okay, there's a couple of variations that I use. We also do incorporate things like fair value gaps and breaker blocks, but for the purpose of this video, you can see that, you know, we have the buy, we have aggressive sell, so we can use this right here. But again, I don't want to just, you know, use that. I'm not greedy. I'm not the type of person who just wants to use this right here, like 1.5 pips. No way. I want to put my stop in a logical place. So the logical place is the swing high. So I can put my stop on there, 4.5 pips. That is a good stop placement for the trade. So there would be your entry, there would be your stop placement. And even better than the last trade, now 1 to 5 is actually a lot closer, right? So that's also something that can genuinely happen. Is the first trade that I got, the total potential risk to reward was 6, right? 50% at 5 and 50% at 7.5 or something like that. It equals around 6. But now if I take 50% at 5 there and the next 50% following the system all the way down here at 17, right? That's going to give me 8.5 plus 2.5, so 11. So this could have yielded 11. This only would have yielded 6. So it's double the actual risk to reward, which is crazy when you think about it. But yeah, that becomes the new setup, right? There's the 3 minute. You come onto the 1 minute time frame. It's in the window of New York, right? 7 a.m. Is about to hit 8 a.m. We do have a news event in here, which is inflation rate, but it's euro inflation rate. Typically, euro news doesn't really move the market. It's dollar news that moves euro dollar, so not too important. But yeah, we come in, we trade out. That is my sign to go break even. So I can move my stop loss to break even now. And yeah, pretty much risk free on the trade. And if we go to a higher time frame to let this thing play out, you will see the take profit number 1 is right here. So that's where 50% of the position gets taken off. And then you just leave the rest running, right? Break even, already secured profit for the day. It is what it is. Obviously, we want that swing low to get hit. It's probable to get hit, but it is what it is. We'll play it on the 15-minute time frame. And then, yeah, pretty much we got the aggression into the take profit after the session. So pretty solid understanding. If we just literally quickly recap, it's very simple. It's what we just taught in our 7 steps. It is the break of structure, change of character. We are pro trend M15. We're bearish M15. High, low. Price comes back up to retest the high. Lower time frame confirmation. Entry as planned. Partials as planned. The weak structure taken out as planned. That pretty much sums up the system. If you want more support, more advice, more like these, deeper knowledge than this, then as I already told you, you can apply to work with me below, fill the form. If not, you just want to enjoy the YouTube, great. Let me know in the comments down below, what video would you like to see next? What would you like to see?